Welcome back. Canadian bank earnings season is just around the corner. Let's go to an expert on what to expect in the bank earnings. We have Mario Mendonca joining us. He's managing director and a longtime bank analyst at TD Cowen. Mario, thank you very much for joining us. You say in your preview note that you expect the tone from banks, particularly on the conference calls when CEOs and top executives speak about the environment, to be somewhat downbeat on things like Canadian economic growth, trends in consumer spending, trends in unemployment, and trends in loan losses. Why don't we begin there? I think there's a fair amount of investor anxiety about those topics as well.
This is really in contrast to the message in the calls in Q3 24. I was caught a little off guard. The message around credit was more positive than I expected coming out of those Q3 calls. Since then, I think the environment softened somewhat, and in the presentations the banks have delivered, either to individual investors or in a broader environment, they've been a little less optimistic. And I suspect we're going to hear the banks offer a more pessimistic outlook on credit losses. For example, if the average bank was guiding to something like 35 to 40 basis points of credit losses in 2024, you could see them raise that guidance to maybe 40, 45. And I think where the weakness is coming from is in the Canadian consumer in particular. And if I want to be really specific here, I'd say the unsecured Canadian consumer. So think about credit cards, auto loans, some lines of credit. I don't think that they're going to send a warning shot across the bow on mortgages. I still think mortgages are safe. I don't think we're going to see a lot of credit losses emerge there. Think mostly on the unsecured consumer side.
And your takeaway is that this may present some downside risk to earnings expectations over the next year, correct?
Yes, I think that as we start to raise, if the banks do in fact guide to higher credit losses for 2025, you'll see a little bit of pressure on banks that have experienced very low level of credit losses so far in 2024. So as we raise those estimates to 25, you could see a little pressure on consensus estimates.
You say about the group and about valuations that valuation is approaching fair value territory. I'm just looking at the valuation on Scotia right now, and it's more than 13.5 times, which I believe is historically towards the high end of the range. You conclude it's difficult to argue for strong upside to valuations. Have the share prices plateaued for now?
Yeah, one thing I want to be clear on, I think you said Scotia at 13.5 times. That would probably be Royal at 13.5 because right. Scotia is still at a pretty
correct. I'm sorry, I was looking at the wrong line on my screen. Right. The forward-looking PE on Scotia is 12.2, according to Bloomberg.
Yeah, I would put maybe a little lower than that, depending on what year you're looking at. So valuation has approached fair value. There are plenty of ways to look at that. You could look at it at a forward P basis. You could look at it at an earnings yield basis, price to book. And I do. In the report, I look at these three key valuation metrics that I focus on. All three are signaling to me that the group is looking pretty close to fair value. And within that context, there are some like Royal that is trading at a meaningful premium to the group, probably 15, 16% premium on a forward P basis to the group average. That's a fairly heavy premium for Royal. Normally, the stock sort of takes a breather when you get to that level. And that's why I'm actually a little more cautious on Royal. I recently downgraded it from buy to hold after a very, very strong year. It reflects not a view that Royal is going to have a bad 2025. It's more the view that the valuation looks full. There are names like Scotia, when I recently upgraded, that offer better value in the near term.
Let's talk more about Scotia. It's under relatively new leadership. It's not that new anymore, but there have been some significant strategic shifts at Scotia. Are they working, in your opinion?
Well, the biggest call for me on Scotia, and just so we're clear, the bank has underperformed the group materially over the last 5 years. Over the last 5 years, Scotia's stock, I think this is still true, it was when I wrote the report, was the only one of the big banks that had delivered a negative return over 5 years. So investors that held this for 5 years had not earned, the stock was actually down over that 5-year period. And during that 5-year period, what stood out to me the most was that Scotia's ROE was down over 300 basis points. Banks like Royal, probably about 100, 120 basis points. So what I'm really focused on now are the changes that this management team's instituting. Are these changes and the environment, are they such that Scotia will deliver better ROE performance? And the argument I make in the report is yes. And I talk about things like the decline in the short end of the curve and what that could mean to Scotia's margin. Scotia is far more sensitive to declining short-term rates because of their wholesale funding than their peers. I talk about how Scotia sort of lost their way on expenses over the last 5 years. Scotia used to be among the most efficient banks in the group. Their efficiency ratio and operating level has been very weak over the last 5 years. And I argue that this management team is going to reinstitute that focus on efficiency. I talk about the benefits to ROE of KeyCorp, the acquisition they did, that 15% stake in KeyCorp they've acquired. I talk about perhaps growing their sort of higher ROE businesses like capital markets. So there's a number of things that I focus on in the report that I say will drive Scotia's ROE improvement in 2025. And if that ROE improvement plays out in 2025, my argument is it's going to support the stock. And that's why I upgraded Scotia. And
the only other major bank stock that you've got a buy rating on is CIBC. And I'll just tell viewers, or perhaps remind viewers, that Mario does not offer a recommendation or target price on TD Bank because he's an employee of that organization. Talk to us briefly about CIBC and why you have a buy rating there.
Yeah, CIBC has been one of those really special stories. About a year, maybe a year and a half ago, they reported an abysmal quarter. There were higher losses in the commercial real estate. The margins looked weak. Everything looked bad. But it was one of those wonderful times to upgrade the stock. And that was around the time I upgraded because they were saying all the right things. They're saying all the right things on managing their margins for more of a neutral result, managing to positive operating leverage. They said the right things on credit losses in the U.S., how those commercial real estate losses would start to dissipate. But what really got the stock moving maybe in the last couple of quarters was when they announced the share buyback. And that really hammered the point home. CIBC was doing all the right things and really determined that when they found themselves with excess capital, the first thing they wanted to do is return it to shareholders. That's exactly the recipe for success, I think, in this space. So those are all the drivers of CIBC's strong performance. Having said that, even though the stock, I think, is up 60% in the last 12 months, perhaps even more than that, it's still pretty good value. It's not one of those very expensive names. But really, what that really is a reflection of is how much room CIBC had to make up relative to the peers. So I still feel comfortable with CIBC. I do acknowledge it's had a very, very strong year, but I really like what this bank is doing.
Mario, thank you.